Thank you again for joining us this morning. Um, we always like to do a little bit of a GASB update, and that's our portion of the presentation here this morning. Here's my bio, just a little bit of information. I've been with the firm here for 26 years, and a partner with the firm and help to oversee our government services.
Good morning, everyone. I am Teena Curnow. I have been with the firm for just over 20 years. I'm an audit manager working exclusively on government audits throughout the year and work very closely with Craig on helping our clients with all of their required GASB implementation and reporting.
All right, so we talk about GASB, and GASB, of course, is the Governmental Accounting Standards Board. And just to frame this a little bit for those of you who would be interested in this information, if you are issuing what's called GAAP basis financials or financial statements in accordance with generally accepted accounting principles that essentially implement all those GASB rules, then this session is certainly pertinent for you. We always like to give a little bit of a flavor here of what's happening at GASB and various standards that have been issued. And some of these we're going to be spending some detailed time on here this morning, and other ones not too much time this morning from a time constraint perspective. So the first one here that we're going to review in detail is GASB 101 for compensated absences. This was effective for December 31st, 2024 year ends. And some of you may have already implemented it, or you're in the process, or if you're a June 30 year end, you're certainly beginning to do that right now. Next standard we're going to talk about this morning is GASB 102 for certain risk disclosures. Two that we're not going to go into detail this morning, but just to make you aware of those, are GASB 103 and 104, which really have to do with the financial statements themselves. Some of it is disclosure with capital assets with 104. And then GASB 103 is kind of a small refresh of GASB 34 for any of those who are familiar with that, that really set up the current reporting model that we have. So some significant implications for the financial statements themselves, not so much in terms of the internal reporting or internal tracking of revenues, expenses, assets, and liabilities, but that's something that we'll talk about in more detail in the future. So to just dig in here to compensated absences, and what I would say with this particular standard, and compensated absences itself is not a new concept. This has been around for quite a while. And at first glance, at first read of this standard a few years ago, it may have come across that this did not necessarily have significant implications, some changes to terminology, kind of just narrowing in on a few topics around compensated absences. But upon a closer inspection, there are some elements of this that really do have a significant impact to the calculation of the liabilities. And we're going to highlight some of that here this morning. So what are the objectives of this standard? Why did GASB issue this standard? I get asked that question quite a bit for various standards. And essentially, I really feel to bring some consistency to it. There were some aspects of the old standard where there were kind of multiple ways to calculate liabilities and some things that weren't necessarily applied consistently. So I really think that's the impact of it, or the reason for it. And the impact of it is there is some changes to some of the recognition criteria here. And some of this, as we go through it, you will see really has a ability to increase your liability that you're recording within the financial statements. And we have a polling question here. Okay. So what are just a few specifics with GASB 101 in terms of, when does it require you to record a liability? So the definitions within the standard, essentially, you're going to consider recording that liability when the leave that has been earned has not been used, or it has been used but not yet paid out. Maybe there's some crossover at the end of the year. So there's three attributes that need to be in place in order to consider booking a liability. The leave is attributable to services already rendered. Essentially, the employees have earned it. This isn't something that's going to be earned or recognized in the future. They've earned it. The leave accumulates. So there's some sort of, tracking of that. It accumulates. It's going to roll over from one year to the next. And then this concept of the leave is more likely than not greater than 50% to be used for time off. So there is potentially some estimation in here, but they've kind of maybe lowered that bar a little bit in terms of the consideration of when you're going to record a liability. Next slide, please. There we go. So just a little bit of terminology here, and we're going to start to hone in some on some of the significant changes. So the old standard, GASB 16, and that goes way back even before my time in doing this, so decades. But under the old standard, essentially it defined a compensated absence where employees will be paid cash upon termination for sick leave and for vacation leave or PTO, vacation leave that's used as PTO. Really, they're going to use it or be paid out. So the key thing that I want to focus on there is that with the sick leave, where under the old standard, essentially you never recorded a liability for sick leave that was just going to be used as sick leave. You were really focused on how much was going to be paid out, if it was paid out, when the employee either terminated or potentially retired, depending on your policy. And I think GASB's position in the past was, well, this is based on some future event that hasn't happened, the individual essentially being sick and needing that time off. So that is a significant change here under the new standard and some of the new terminology here. Leave, you're considering leave where employees receive one or more of the following: cash payments when the leave is used for time off. And that does include sick leave. So that is really one of the more significant changes with the standard that you now need to take into consideration that was not taken into consideration in the past. Any other payments, such as a payment for unused leave, obviously when the individual leaves the organization, most organizations do that for vacation leave. Sick leave, it's really variation among organizations, what their sick leave policies call for in terms of a payout, either when an individual leaves or retires. And potentially you have a non-cash settlement for compensated absences. Maybe that rolls into a defined contribution plan. That does need to be taken into consideration under this standard, although I can say we do not see that very often. So one of the common questions that I've been getting asked quite a bit as we work with our clients to implement this standard is, what about the pay rates? What pay rates do you use? And of course, the mind thinks, okay, we're talking about payments that are not going to happen until the future sometime. Either, and I'm going to focus a lot of this presentation on sick leave, and I'm going to talk about it, but either they're going to take a sick leave, a year from now, 2 years from now, etc., or maybe you're considering a payment when they retire. And of course, some of those employees, they may not retire for 10, 15, 20, possibly 30 years. So what pay rates do you use? Well, you use the rates that are in effect at the end of the fiscal year. There's no need and no requirement from GASB to kind of project into the future what employee pay rates would be. You're just using that at the end of the year, and that's what the liability is going to be measured on. And of course, that will change every year. It's not a static measurement. All other things being equal, the liability will change each year just because of the pay rates. So they do need to be updated, but you're looking at that at the end of the fiscal year. A couple other items here with the standard itself. There is a little bit of relief here for footnote disclosures. For those of you familiar with the financial statements, there's a table for the changes in long-term liabilities that shows beginning, additions, deletions, ending. In the case of compensated absences, earned compensated absences and used compensated absences. In the past, that needed to be grossed up, and that created a little bit of challenges, somewhat difficulty getting that information at times. Certainly does not kick out from your accounting system. GASB has said that's no longer required. So you can show that as a net change and a little bit of relief there. And then just a small disclosure item, you're no longer required to disclose which governmental fund is used to liquidate the liabilities. So honing in here a little bit closer on the sick leave. And again, I'm going to talk a lot about sick leave. Compensated absences encompasses more than sick leave, but where we are seeing much of the change is within the sick leave category or classification. So again, you're no longer focused strictly on that payment when an individual terminates. or terminates, leaves, slash retires. You're looking at that. That is part of the equation, but you're also looking at them and the potential of them using the sick leave as actual sick leave. And what is the significance of that? Well, what the standard digs into is, and it really depends on your own organization and your policies. But when an individual uses sick as sick leave, well, of course, that's at their full pay rate. They use it as sick leave. They're being paid their full pay rate. When the individual is paid out at termination or when they leave, oftentimes organizations have policies that limit that payout in some fashion. It's really kind of all over the board with organizations and the policies that they have. Sometimes it's limited by number of days, sick days. Sometimes it's a specific dollar amount. Maybe it's a 50% of their pay rate. It's really kind of all over the board as terms of what those policies look like. But many policies do not pay out the full pay rate at termination. It's some sort of limited amount. And the significance of that is obviously you have at the end of the year employees' total sick bank, and I'll use the word bank there, and some of that sick bank could or is probably going to be used as regular sick leave, as time off. That's at their full pay rate. And then some of it's going to flow through to the payout provisions, which is at a different rate. So you now need to estimate that. You need to do some sort of process to allocate their sick bank into probabilities of those two buckets. Now, if by chance your organization does pay full pay rates for sick leave when an individual leaves, then this would be less of an issue for you because obviously they're going to be paid the same rate no matter when they use it. So that could be less of an issue. But like I said, many organizations do have a different payout provision when they leave. Slide talks about the probability threshold. Again, that more likely than not could that in itself could potentially be higher accruals. Another thing I'll say about the standard is it's much less prescriptive. More and more standards that we've seen issued by GASB really kind of talk about more of a principles based as far as a rules based in the way that they lay out the standards. And this is very much that case. So when we're gonna dig into a little bit of detail here with the calculations, not too deep, but when you see that, just know that GASB really doesn't tell you exactly how to calculate this concept that I've talked about with sick leave, of allocating it to and estimating a probability of how much is going to be used as sick leave versus payout at the end. GASB literally provides no guidance on how to do that. And that can be good and bad. Certainly some advantages to that because it provides you with flexibility in how you go about determining those estimates and modeling that calculation. But obviously a disadvantage in that there isn't a prescribed format where you can just go follow the example from GASB and use that to apply to your situation. So something to take into consideration as you're working to implement this. And obviously the further it goes, more and more organizations will be implementing it, and there should be some more samples out there. So there are a couple of exceptions here to this general rule of recognizing liabilities for compensated absences. If the leave is dependent on some sporadic event that only is really going to impact a small a small portion of the population or the employees, then you're only going to recognize that leave when it commences. Some examples of that are parental leave, military leave, jury duty, things like that. You're not trying to project, when or for each individual employee, when or if that could happen. So that's a little bit of a bonus there. Those are just going to be recognized as expense when the leave commences. Some organizations have unlimited leave policies. It's not common, but we're seeing a little bit more and more of that on those unlimited leave situations. Again, there's no bank that's building up for that individual. So you're just recognizing that leave when it's taken and expensed at that time. I mentioned defined contribution plans earlier. If by chance your sick leave or your compensated absence policy includes some rollover into a defined benefit plan or possibly a post-employment benefit plan, that's not going to be recognized as part of these standards. You're really looking at the other standards that deal with those defined benefit plans. So what are some steps here? Oh, excuse me. On this slide, just a couple reminders. No change in the recognition in governmental funds. So, for those of you who are familiar with a GAAP basis financial statement, you would know that gas or governmental funds are under modified accrual accounting. Not going to get into that this morning, but that more of a short-term focus. So, really, no changes there. You're just booking that as a liability if it's due and payable, which would really be likely probably someone retired at the end of the year. Maybe they didn't get their payout until after the end of the year. So not a lot of changes there. So we're really looking at full accrual funds, such as proprietary funds, or the government and or the government-wide statements. Now, I will say, if you're working with someone, possibly your auditors, assisting you in preparing the financial statements, I don't want you to misinterpret that and say, oh, well, this is something we don't need to worry about internally. It'll just happen as part of building the financials, because that's really not the case here. There's certainly a complete redo and remodel of the calculation that's going to be needed in many cases, and that's not something that can be tacked on as part of the financial statement process. Really requires a lot of internal work there and reviewing your policies and your internal information. So just a note on that. And then also in the year of adoption, one thing not to pass over is with most GASB standards, they require you to go back to the earliest period presented to the beginning of that period and restate. So just to give an example here, if you're doing this for June 30, 2025, well, you really first have to go back to June 30, 2024 or July 1st, 2024, whichever you want to say, and redo that calculation based on the new model that you create. And obviously that'll expect to be different numbers that are produced for that liability calculation. So you need to go back to that beginning year and then do that calculation and then roll forward to the end of the current fiscal year. Again, that June 30 example, that would be June 30, 24 and June 30, 25. So you're really calculating 2 years at once within that fiscal year.
Hey, Craig, we did have a question come in.
Yeah.
It says, it sounds like you could carry a portion of sick liability at the termination payout rate, and then any excess could be carried at the employee pay rate. Is that right?
Yeah, that would be one way of looking at it. I haven't necessarily seen the calculations done that way. I think and I'm going to talk a little bit here about sort of breaking apart the sick leave calculation, but I think the concept that you're hitting there is you are looking at probabilities of how much is going to be paid out at termination versus how much is going to be used as sick leave. I don't necessarily think that it's you calculate one and then the other is the plug or the default, because there's different probabilities that bake into each part of the calculation. So we'll talk about that a little bit more here just on the next couple of slides. So what are some steps to take in order to go through this process, to do the calculations, to think about this, remodeling if it is necessary for your organization? Well, first off, really taking a very close look through your own policies and summarizing that information. And those are things that potentially change over time. Certainly, if there's union contracts involved, those benefits may change, and maybe without union contracts. But you want to take a look at your current policies and summarize that information and be familiar with what are the carryover provisions, what are the payout provisions. You may have different provisions for different classes of employees. The next step, and I hadn't mentioned this before, but I want to dig into this a little bit, is there's really, and GASB doesn't hit on this too much at all within the standard, but there's really a policy election that needs to be done here, specifically with the sick leave. And what I have here on the slide, mentions FIFO or LIFO. And you may be saying to yourself, well, wait a second, that's inventory. FIFO, first in, first out. LIFO is last in, first out. And GASB doesn't use those terms. They call it more of a flows assumption. But as we started to work with clients and implement this, it became evident very quickly that this was a very important distinction that the organization needs to consider. So let me explain that in a little bit more detail. So I'll just give an example. Let's say that you have an employee and at the end of the year, their sick bank that they have built up is 50 days. We'll say that. And then in the next year, they earn 8 more days and they use 5 days. So the question that becomes extremely relevant is what bucket did those 5 days that they used come from? Did it come from the 50 days that were in the bank in the prior year, or did it come from the amount that they earned the 8 days in the current year, in that future year? And of course, if you would say, well, we're really taking it from the bank first, they would come from the 50 days. Well, that would be FIFO, first in, first out. If you would say, well, no, they're really taking it from what they earn in that current year first before they dip into the bank, that would be last in, first out. Now, the significance of that is, and really what we're seeing with the implementations that we've done so far, is that in many cases, there's not a lot of dipping into quote unquote the bank. Now, you always have particular individuals for various reasons, but you're really looking at this across your entire population and calculating averages. And there might be some dipping into the bank, but if you consider it that LIFO flows assumption, where they're really using their current year sick leave first before they dip into the bank, then that's going to limit the amount of liability that is potentially considered as used as regular sick leave, because you're not dipping into that bank too much, and you're really going to push more of that calculation to the payout provision. Now, one significance of that, of course, is the amount of the liability if you have some limited payout provision. Because obviously, if they're using it as sick leave, that's at their full pay rates. If the more that is pushed to the payout provisions, if you have a limited payout, that's going to be at a lesser rate. So that takes on some real significance there in terms of that calculation. It's important to consider, you're going to take a look at historical data and getting your own trends, looking at that hopefully over several years to calculate averages for this. And then you really kind of, when you look at the amount that's going to be paid out at retirement, you also have to consider the probability that that's going to happen. Now, some organizations, when you terminate, no matter how long you've been there, you receive your sick leave. But many organizations, it's really when you retire. So if that's the case, you also have to consider what's the probability that they're going to retire and receive that payout. Obviously, if you have someone that's been in your organization for 5 years, there's less probability that they're going to retire than for someone that's been there for 30 years. So that's something that you have to take a look at from your own internal information as well. And of course, document with your process of kind of creating this model that's not necessarily prescribed. You want to have good information behind the scenes that shows that. So just a very quick slide here, and I'm going to hit this very quickly from a timing perspective. This isn't meant to show you the calculations, but more of kind of the end result. So just a very basic example here with a few employees, number of days that they had at the end of the year, their pay rates. And that yellow portion is kind of the first part. This is how much is expected to be used as sick leave at their full pay rates. The probability factor in this example that was determined from looking at a LIFO assumption and past experience was about 5% of their bank could be expected to be used as actual sick leave. So that calculates that dollar amount. And then the remaining days roll forward to how much is expected to be paid at retirement. And there's, again, that second probability. You have some newer employees with less of a probability that they're going to be paid out at retirement. So ultimately, you calculate both of those items together and come up with a total. And then you do have to include salary related payments. So most of the time it's going to be FICA. Potentially, if you have a defined contribution plan, you're tacking that on as well. But you need to include those payouts as well in the total liability. So that's what we have for compensated absences, and I'm going to turn it over to Teena now to talk about risk disclosures.
All right, everyone. So I'm going to finish up our presentation over the GASB statements, talking about GASB 102, because this is another standard that is currently going to need to be implemented for anyone on the call that is reporting, GAAP basis, footnote disclosure, financial statements. And so this standard is applicable for any periods beginning after June 15th, 24. That's just how GASB words all standards. It's always beginning after or ending after. So in this case, you'd be looking at, for the vast majority of those on the call here, either fiscal year June 30, 2025, or calendar year December 31, 2025. So thinking about that, obviously you will be implementing this in your current year that you're working through from an audit standpoint. So what GASB 102 is related to risk disclosures, and kind of the overall summary of the standard is just acknowledging the fact that local governments have a variety of risks that they are faced with that could negatively impact their service that they can provide, or impact their ability to meet obligations as they become due. For example, debt, paying on debt, things like that. Some of these risks are already built into other standards and are required to be disclosed in some form or another. But this is really expanding on that and kind of pulling everything together. So it is a disclosure standard. So you wouldn't be changing anything with your numbers internally. It's strictly for external reporting purposes. So unlike the compensated absences, where you may be actually recording some of this activity, or calculating numbers and putting them into your number pages of your financial statements, this is just a disclosure standard. So what the standard defines are two different things: concentrations and constraints. And so if you go to the next slide, we'll talk a little bit more about what that means, what these are. So concentration, the definition in the standard is a concentration is a lack of diversity related to an aspect of significant inflow of resources. So examples that they have in the standard are major employers, collective bargaining agreements, vendors, and providers of financial resources. So people like granting agencies, things like that. So what you have to think about is, in the sense of a concentration, is, do you have a singular customer or a singular funding source that if something would happen to that funding source, how would that impact your entity? And if that would have a significant impact and an event has occurred, that's where this would trigger this disclosure. And we'll talk about that a little bit more in subsequent slides. So the next slide explains constraints. So similarly, as far as what a constraint is, or concerned, is a limitation on the entity itself. So this limitation could be from an external party. It could be from the entity itself. The board could approve to limit, something, spending, for example. That could be a constraint. Other examples: raising revenue. If you if you rely on tax revenue and you are limited with how much you can raise taxes, that you need the inflow to cover your expenses, that could be a constraint. Limits on spending, incurrence of debt. If you are at your debt ceiling and you can't take out any more debt, but you need more money to fund the programs that you need to offer. And then mandates on spending. That would be more regulatorily based. So for example, if you have, say, an authority or a municipality and you have required testing that needs done, things like that, like on water, sewer, and new regulations are coming in place that are really going to significantly impact how much testing needs done, the cost of that testing, and that if that could be a significant impact to the entity, that could be something that would come into play as far as a constraint that would need disclosed. So what needs disclosed? If you have a situation like this, then what needs disclosed is the actual concentration or constraint that's known prior to the issuance of the financial statements. And that concentration or constraint, essentially that it makes the entity vulnerable to a significant impact, negative impact. And what that event is that could cause this substantial impact, whether it has occurred, is likely to likely to occur within the next 12 months after the issuance of the financial statements. So this is key here when we talk about issuance of financial statements. It doesn't mean as of year end. It means as of the time your financial statements are issued. So if you have a normal 6 months, 9 months time frame from year end when your financial statements are needing to be issued, that 12-month period is from that time on, not from your year end. So it could be something that an impact that could happen more than a year after year end. You're looking at it from the standpoint of the issuance of the financial statements. So what are some things to consider for this standard? If you go to the next slide. Any concentration or constraint that does exist, and the event that's associated with it, and then what actions the government is going to take prior to the issuance of the financial statements to mitigate the risk. So if you go to the next slide, we'll talk a little bit about that here. So what you will need to be looking at doing here now, if you're a June 30 year end, obviously, because your audits will be upcoming, is thinking about and developing the potential concentrations and constraints that you as an entity have, what that means to you, what impact that could have if you lose that customer, or if you can't take out more debt, or if you can't raise taxes. Whatever the concentrations and constraints you have, you need to identify what they potentially are, and then you'd be better able to understand what needs to happen if that event occurs. Basically, a risk management kind of protocol is what you'll have put in place. But what you also need to be aware of is you don't have to find concentrations and constraints. You don't have to think of every worst case scenario. Really, what we believe based on reading the standard is if you have a concentration or constraint, you very likely already know about it now. Whether an event has occurred or not, you know if you have significant customers, you know if you have limits on raising your revenue source potential, or if you're reaching your debt maximum and you're not going to be able to take out any more debt. You already know most likely what those concentrations and constraints are. So you don't need to be going down that rabbit hole of trying to think of every little thing that could potentially need to be disclosed with this standard that needs to be implemented. The other thing, just last bullet point here, comparative statements. You only disclose for the risks that existed as of the reporting date of the current year. So I'm not sure how many of you report on comparative. We have comparative information, but just a little bit of a reprieve there. You only have to look at the current year from that standpoint. So the other thing I wanted to point out here, not just with this standard, but with any of the standards, GASB standards that we talk about, the GASB website is a public website. So if you go to their website, and it's just www.gasb.org, you can see all the standards, all the pronouncements. You can read them. They are public information. This standard particularly has a couple examples in the standard at the back of it, and to kind of help walk through, here's some examples, here's the thought process you need to go through, here's the conclusions that could be reached, and then an illustrative disclosure for the purposes of disclosing that constraint or concentration. So I suggest, again, with this standard or any standard that you need to implement in your entity, think about going to that website. It's It's very good and useful information that you can read through and try to kind of understand what the thought process is behind each of those standards and why they're being implemented and what you need to do as an entity. And then obviously, if you have any questions, reach out to your auditor and have a conversation with them. Ask about what questions you have on the standards that you're reading, or asking for some expanded discussion, interpretation of the standards. We're always available to our clients to talk through that. So just also use that as a tool for sure.